Hi, everyone. Welcome to our channel. My name is Tarmila Rajasingham. I'm a real estate agent based in the Greater Toronto area, and I'm here with my colleague, Carlos Pietrasanta. We're going to be discussing first-time homebuyer financing with Richard Tartaglia, mortgage agent from Vine Group. And he has over 9+ years banking and mortgage brokering experience, and Richard brings an extensive financing knowledge to the table. And my husband and I actually had the privilege of working with Richard on a number of occasions. So it is such an honor to have you here, Richard. Thank you for joining us. Will you please give everyone a little bit of an introduction about yourself and how you got started in mortgage financing for real estate?
Yeah, sure. So I've been doing this for coming up on 10 years now. Started at the bank as a mortgage advisor, Scotiabank for 5 years, transitioned out to the Bank of Montreal, and then I got married. It would have been end of going into 2018, end of 2017. And basically with the salary with my wife at home, this is a 100% commission gig, business for self. And, I decided just take the leap, and with this role, able to help a lot more people than I was able to working at the bank as a mortgage specialist. So I never looked back, and I just love this role as a mortgage broker, able to help more people because you have access to much more lenders in a nutshell.
So Richard, one of the first questions we have for you is, what is an overarching process for mortgage qualifying when it comes to a first-time home buyer? Is there a difference?
So first-time home buyers have a challenge in the market that we're in. Down payment is the main focus. So, if you're a first-time home buyer, you've saved up some money for a down payment. If you have less than 20%, and in this market, with average homes being well over $1 million in Toronto, that's $200K if you're trying to aim for 20% down. So identify what down payment you have so that we can then assess your mortgage ability to qualify. Have a conversation with a mortgage broker to understand that. If you have less than 20% down payment, we're roughly looking at around 4 times the income, the qualifiable income to qualify that person's mortgage. If you're making $100,000 and you have less than 20% down, that is roughly $400K that you would qualify for. And there's stipulations to that. So what is the qualifiable income, et cetera. If you have more than 20% down and or 20% down or more, roughly 5 times the income. So that would put you at around $500K for the mortgage amount. So income is a big focus, but first understand what your access and down payment, have a conversation with your mortgage specialist, and basically go from there. But the first conversation, always have conversation, first step in the process, have your conversation with your mortgage broker so that you can have your conversation with your realtor.
Yeah, and sometimes Carlos and I, when we were talking about first-time home buyer, we realized that when, as real estate agents, often people don't even know that they actually can qualify and that they are in a financial situation that they are able to buy their first home, but they just don't know unique financing strategy. So what do you say to people who are in this situation, who's not even aware of the financial condition? So should they get in touch with someone like you and start a conversation? And what's that conversation like, especially for someone who doesn't even know if they're ready to buy yet?
So for someone that doesn't know if they're ready to buy yet, have the initial conversation with a mortgage specialist. You may realize in that conversation that, this is maybe 2 or 3 years out for you. Maybe you're able to do this right away. What access do you have in terms of a down payment? Sometimes that becomes a challenge for people because they say, well, my family's willing to help out, but how much are they willing to help out by? Yeah. Did you talk about a dollar value? And then once we figure that out, then we can discuss, how much do you actually qualify for? Because we need to know the down payment amount. That's the general process. The financing condition, it's tough because lenders want to appraise the property, and the financing condition on an offer. So you make an offer, you basically make it either a firm offer, you have some conditions on there, and us as being the financing guys, we are often asked, can I go in firm on this offer? The market is what it is, and sellers are accepting basically for the most part only firm offers. Am I right?
Yeah.
So there's a risk layer to that. Client has to understand the risk. What are the risks involved with my specific application? And that conversation has to be very thorough. So you have to disclose exactly what the potential risks are. And people can be very complicated from a financial perspective. So we have to get all of the documentation in, do a thorough review, check credit, and then offer up what we call it is a pre-position rather than a pre-approval. A pre-position is more fair in terms of language than a pre-approval, because a pre-approval implies that there's a guarantee for an approval, because the word pre-approval is in the pre-approval word, or approval is in the pre-approval. So and you often see online RBC, they offer get pre-approved in 30 seconds. How are you doing a proper analysis in that type of a pre-approval? So when we get into complicated individuals, you have to have an understanding of, like, what if the property doesn't appraise that value? What do you have as fallback to maybe recoup the difference if that's the case? But without getting too technical, keeping things simple, we have the conversation with the mortgage specialist, and then we talk exactly about what's going on with the application. They can be very, very complex, and nowadays people are complex, and credit underwriting rules have become much more stringent, and there's a lot of detail we have to make sure we're covering.
Richard, so my question is, like, even going back to like down payment, how much do I even, like, as a first-time home buyer, how much would I need to even start even maybe looking at properties or even speaking to a mortgage agent?
So really good question. Minimum down on a property is 5% on the first 500, and then 10% on any amount thereafter, up to $999,999. So 5% on 500K is 25,000, and then if you're going up to 999,999, that would be essentially another 50K. So in that scenario, buying a property for $999,999, that's a $75,000 down payment, and you can adjust it accordingly depending on the purchase price. Now let's say you do buy that place that's $900,999. Those types of price points for minimum down payments, the amount to qualify for that size of a mortgage, you're looking at over $200,000 in income. So we have to make sure that type of a client is in line for that type of a mortgage, and that's the initial conversations that we'll have, just to make sure, is this realistic for that first-time home buyer?
Right. And I think that's one thing that I've encountered as well, where a lot of first-time home buyers are thinking, well, I have, like, let's say a $50,000 down payment. I can therefore afford a mortgage of $900,000 or $800,000. But there's more that plays into that, right? Like, it's income. There's other pre-qualifying criteria that you need to fit as a first-time home buyer, regardless of whether you have your $50,000 or $25,000. Correct?
Yes. Definitely. Income and like credit, and maybe you have other debts. If you have other debts, that will affect the amount of income that you can qualify. The calculation is essentially, of your income, some percentage is available to be used towards this property. That's usually 39%. And then of your income, you can include the debt for this property plus all of your other debts. So that's 44%. We have to be within those parameters. Credit can affect that. And how do we view income? So people say often, I make $100K a year. Okay, are you paid hourly? Are you paid salary? Are you on contract? Are you business for self? How did you determine that $100K amount? That's what we get into and we really dig into. And a good pre-approval is one where a full document review is looked at. Pay stubs, we look at the year-to-date amount you've been making up to that certain point in the year. Did you take some time off? Was there mat leave? Mat leave affects things. Was there some time off for any other reason that was unpaid for? If you're not trending for that same amount, that will affect things too. So it can get very complex on what seems to be a simple application. Once we unveil the real nitty-gritty details, it can change.
Okay. And with that being said, sorry, like, do you suggest, like, let's say if I have high debt, do you suggest me paying off, or like as a first-time home buyer, to pay off some debt prior to even speaking with you? Or is that something that you will determine and be like, okay, you know what? Like right now you have this high debt. Let's work on it for like a few months and then come back and we can actually get, the application going? Or like, what is your like suggestion with that?
So sometimes that's the recommendation is let's try to bring the debt load down over time, and maybe we revisit this when your debt, maybe you've paid off your car loan, and at that point we can revisit it. Maybe the end result of the conversation is we can do this, but we do need to condition the approval as if you had paid that debt. So we present it as if that debt is paid. Okay. And then after it's approved, they can provide documentation to show that it's paid. Sometimes we can leave it. Sometimes we can leave that debt if the numbers allow for it. And every debt is viewed differently. Credit card debt is viewed as a larger repayment. Usually lenders want to see you repay that at 3% of the balance over time. Line of credit debt, if it's unsecured, is usually around 3% of the balance, depending, and lenders can vary. That's why speaking with a mortgage broker is very valuable, because maybe this lender views you as in this light, maybe this lender views you in this light, and maybe this lender over here, that actually the way that they would view your application is they would approve you for what you want when all the others won't. Maybe they're even winning on the interest rate and they're better than the others. So and maybe the product fits with your overall goals and your plan. So sometimes there's that opportunity to really demonstrate value as a mortgage broker. That's why I believe personally that everyone who is going to qualify for a mortgage as a pre-approval should deal with a mortgage broker. That's my personal opinion. And there's different channels people can get mortgages in. You can go to a branch or a mortgage specialist at a bank or anywhere else. But essentially, with a broker, you have access to many lenders in one conversation.
Right. And I guess even like one little tip that I'm going to give for first-time home buyers, is simply because I do have also background in banking, is to make sure that when you are paying off these debts, to get like a discharge, right? Like letter, document, some form of documentation saying that you actually have paid off these debts. Because I personally came to a situation where I had paid off a debt, and that when I got to my mortgage, that was going to it was harming my application. Meanwhile, I had paid it off. So I had to go looking through emails, documents from like 3-5 years ago from when I did pay it off, and I had the actual discharge paper, and I'm like, here it is. It was paid off. It's just that it wasn't clear for my credit, right? So that really saved my behind, because like that's important, right? To keep that documentation that it's paid off if you do pay it off. Yes,
100%. I have a client right now who's going through the same thing. There's debt that is paid, but we have to show it is paid. It's crazy. The amount of I would say the first thing to do as a potential mortgage applicant is get your documents sorted, digitally labeled, be ready. Dharmila, you know about that.
Yeah, my favorite thing to do. No, I really do. You have no idea. My folders have folders. So I love label. That's like my favorite things. Anything to do with logistics and labeling things, I love that stuff. So I think that's part of that, right? Making sure you're giving that, that value to your clients. So make sure, you as client, you expect that from your mortgage agents and your realtors, to make sure that you have all the information that you need so that you're ready. And because the market is moving at a pace that so many people are being priced out, you can't catch up. So just make sure you're working with people that are serving your best interest, and that if they are moving you in a way that it's, that is prepared you enough so that you do get the right property at the right time in the way that you want it, so that people aren't pushing you to it, and that gives you a lot of room and flexibility to ask questions. So I think, in my first video that I did with you, Carlos, when we bought our first property, our experience, one of the biggest, advice I gave to people, and one of my biggest learning was that I wished I asked more questions, and I didn't, because I didn't know anything. And I thought, I'm trusting this professional, but it's also, I went into it, not knowing anything. So when I had to buy my first investment property with Richard, I was relearning I was learning everything for the first time, not even relearning. And I was really unlearning a lot of things, because I was in a moment where I wish I'd known. So that's my biggest advice to people, is that ask the question. there's no question that is a bad questions. And that leads me to Richard, asking you a questions about kind of this market right now. Is there a difference between in terms of rates, a variable versus fixed for a first-time home buyer? Is that a cookie cut question that you're able to answer?
Yeah, it's a really good question. There is a difference on interest rate. So if you're buying a property and you have less than 20% down, you have to pay a mortgage insurance premium to be able to set that up. So we need to get past the insurer, the CMHC, Genworth, or Canada Guarantee. I think they have a different name now. Sagan is their new name. But essentially what you're doing is you're paying a premium on your mortgage amount to have the mortgage be insured by that lender. The lender is lending their money out as an investment, and when you are borrowing that mortgage, the lender's investment is insured, so their risk level comes down. And for any investment, there's a risk amount. If we can bring the risk amount for any investment, then the return should come down. Lower risk, lower return. So same thing for a mortgage. The lender is lending money out in the form of an uninsured mortgage. You're paying for the insurance as the borrower, but that lender's position is protected. So they should offer a lower return, which for you as the borrower is a lower interest rate. And that oftentimes can offset the premium that you would pay for that insurance. So sometimes, it's like this year alone, we had 5-year fixed rates I think in 2021, they were at 0.99% for high ratio, when at the same time, high ratio meaning less than 20% down, or insured, same thing. At the same token, the conventional mortgages for people with 20% down or more were over 2%. So sometimes you can see a big difference in the insured rate versus the conventional 20% down or more rate.
That's great. No, that's great information. And in terms of given our market right now, has any of the threshold in terms of mortgage financing from the A lender, so the big banks, has that changed at all for first-time home buyers, or for anyone who's looking to get into mortgage financing, especially with our climate right now with the pandemic? Has any of that taken effect at all?
There has been changes over the recent years to try to help first-time home buyers, but for the most part, there was the shared equity program that the government came up with in the Toronto market, or in the GTA and in Ontario. Really, to me, those programs have been kind of smoke and mirrors in maybe political plays. You may have seen more popularity for those types of programs out west, where price points are much lower, like in Edmonton. But there hasn't really been a good palpable change to help first-time homebuyers. It's really tough for first-time homebuyers with less than 20% down. What I find most of them need is the bank of mom and dad.
Yeah, that's usually how it happens, right? That's usually how it works.
Yeah, or maybe they have some, I don't know, some scenario. The amount of income required is high. You may find that person that makes that really good income to get them into that home with less than 20% down in Toronto. But for anyone less than 20% down, you automatically you're capped at $999,999. That's a given, and it has to be your owner occupied home. So there's no rental for less than 20% down. There just doesn't exist. There's no lender that will do that.
Awesome. That's great information. Thank you, Richard. And Carlos, do you have any other questions you want to ask?
Yeah. So Richard, I have a question in regards to the CMHC insurance. So as a first-time homebuyer, if I'm putting less than 20% down, I will require this insurance. How do I go about obtaining it? Like, is that something that I have to apply separately, or is that something like that gets done for me? Like, how does that all work?
We would apply for it through the same application to the lender. the background of how it actually gets applied for, it's actually the lender going to CMHC with the deal. And then CMHC comes back with a certificate. It might be CMHC, it might be Genworth or Sagan. And basically they come back with a certificate. The certificate is added, that you get an insurance number. The insurance number gets added to the mortgage commitment, and then it's passed on to the borrower. And that's how it works from a process standpoint. The amount of the insurance depends on the down payment amount, and oftentimes we'll see someone, I want to put 9% down, and we have a conversation. Well, why don't you try to do 10%, because your premium will come down. It'll drop down from 4% to 3.1% on the total amount. So now you've just saved $5,000 in putting just another percent down on the down payment. So there's strategies like that you can take. The amount of the premium is tiered based on the down payment amount. So 5% is 4% premium based on the mortgage amount. Up to 10%, I think it's 3.1. After 10% is 3.1, and then after 15% down or more up to 19, it's something like 2.2, something like that.
Okay, and is that insurance like based also on the property that I'm looking for? So like, let's say because you're saying like the application gets so once we do like the initial application, then the mortgage agent would then take it to CMHC with the deal and say, okay, this is what they're trying to obtain. So I'm assuming the CMHC or Genworth and whatnot, do they have a certain criteria as well? Can there be potential pretty much for me to be declined for that insurance?
Yes. Often we have to get an approval from the lender, and we have to get an approval from the insurer. Okay. This is another reason why it's very difficult for first-time home buyers going in firm on offers, because we have two layers to get past. We have to get the insurer to approve it. Your mortgage broker or mortgage specialist has to know that this is going to get approved with the insurer. It's part of the pre-approval. And often the insurer's guidelines are slightly different than the lender's. Sometimes the lender will approve it, but the insurer won't approve it. And we have three tries with insurers. So we have CMHC, the three insurers, and sometimes the insurer will be a little bit different one amongst the other. For instance, CMHC has a stated income program who may consider income for an individual with less than 2 years of business for self income. So maybe you have a business that you don't have 2 years history with, that we can get approved with CMHC. That's a program that exists at CMHC alone.
Okay.
I wanted to ask around that. So how long does an application process take, for example? Just wanted to know what the timing would be, especially when you have to align it with the closing.
Yeah. It really depends on the the amount of other deals that are being reviewed. And it depends on the lender too. So Scotia is very quick with our contact there. The TD has been better. They've been getting better. National Bank's getting better. We're working with Simply and CIBC through them, but essentially it depends on the lender, depends on the timeline. Sometimes we have to go to a specific lender because of the timeline.
So another question, Richard. So let's say, for example, if you pre-approve me or pre-position me into a mortgage of $600,000 as a first-time home buyer with my down payment, what do you think about maxing out that, let's say, mortgage? What if I don't need the full $600,000? Like, can I take the full 600 for, like, let's say maybe even closing costs, or like maybe buying furniture later in the future?
The amount, so oftentimes borrowers that are first-time home buyers need the full amount. So if you can come down on the amount that you are pre-approved for or pre-positioned for, then in that case, you can take the smaller amount. Lenders base their amount of mortgage on loan to value, so value against the loan. They're not going to lend out more than what your maximum is on that property. But if you're putting the minimum amount down, then you basically are going to have to leave some qualifying ability on the table. Maybe you have 15% down, and then you've been pre-approved for more, and then but if you need extra money, then you could maybe put 5% down to keep the extra 10% for those closing costs, or for that furniture, or maybe a slush fund, emergency fund, who knows. We have that conversation around what do you really need to put down, and then we have to consider the premium as well. Is it worth it to go less down? But lenders do want to see upfront 1.5% of the purchase price available to them for closing costs. So the client needs to have their down payment, and they need to have 1.5% of the purchase price available to close on the deal. We have to actually present that to the lender before the lender is going to give a commitment.
Okay. All righty. Okay.
That's awesome, man.
Yeah,
I learned a lot today. No, that's good, because it's so different depending on what circumstances everyone's in. So we haven't quite been in circumstances like that. We never did our first property with you, so I didn't realize all that.
Yeah.
So Richard, do you have any last minute advice for first time home buyers, especially the ones in this competitive market, and how they can, get the right financing to get started on their first home?
Last minute advice for first time home buyers: consider different markets if you're able to work from home. That's a big one. I'm finding more clients maybe having to look outside of the GTA, but if they can work from home now and they have that on paper, the lender is going to want to know that they can work from home in a formal arrangement. And maybe that means that if you're not being pre-approved for as much as you hoped for, which is often the case because it's difficult to qualify for those first time home buyers, maybe consider different markets. If you're looking to get into the market, taking that first step, that consider it where you have lower price points. And nowadays, everyone who's working from home in formal arrangements after the pandemic, that could become a reality for you. Previously, if you had to commute to work, you could only look within a 1.5 hour radius of where you work. Because the lender, if you're looking 2 hours out, they're going to say, well, how are you going to keep up that commute? That's what the lender would say. But, be thorough, be realistic, call your mortgage specialist, and know this all up front before you engage with the realtor. Certainly before you are looking at properties physically, that you need to make sure that you have something to back you.
Absolutely. Those are great tips, Richard. And I often find that people they don't know what to bring to the table and what questions to ask a mortgage specialist or a real estate agent. And, they have to meet us halfway so that we're able to help them. So I'm really glad that you mentioned that, so that people are able to share those kind of information with you up front, so that you're able to best help them. So, Richard, how can people get in touch with you? That's the best way to reach out to you. Email
is good. Richard@vinegroup.ca. So I'm with Vine Group. We're the #1 team within Mortgage Alliance for, I think it's 4 years coming now. Email's good. Richard@vinegroup.ca, or give me a call, 416-629-8896.
Beautiful. Thank you, Richard. And I'll make sure to add that information in the description below so that everyone has it. Thank you so much, everyone, for watching. If you like this video, give it a thumbs up and subscribe to our channel so you can get more content like this. And if you have any questions around anything to do with financing for your first property, how to get into the home ownership in this market, leave it in the comment section below. Myself, Carlos, Richard will all be able to help you out as much as we can. And thank you so much for watching, and we appreciate this.
Alrighty, well, thank you very much, Richard, for joining us today. It was a pleasure speaking with you. For any first-time home buyers that are looking for a mortgage, I will leave Richard's information all below. Y para toda la comunidad latina, recuerda que también Richard habla español, así que él te puede ayudar a ti en español, ¿verdad, Richard?
Eso es cierto, crecí en muchas diferentes partes de Latinoamérica, y si tienen cualquier pregunta o cualquier cosa, me pueden llamar.
Perfect. So that's perfect. Thank you very much, Richard. So again, if you do like this video, make sure you subscribe, leave some comments below, and we'll be sure to get in contact with you. Thanks, everyone.